Hello, my name's Nasha Haider from Innotech Consultants. Today we have the pleasure of speaking with Paul Zaman, who's the director of Qualvin Advisory. Paul's had an extensive career in Europe, Singapore, and Australia in consulting companies such as SRI International and Accenture. He's also held senior positions in telecommunications companies such as British Telecom, Telstra, and Maxis, and stockbroking companies such as JB Ware and ING Bearings. Currently, Paul is the executive fellow at the King's College Business School in London. Hello, Paul. It's a real pleasure to have you with us today.
Thank you for that generous introduction and very pleased to be here today.
So I see on your LinkedIn profile an interesting aspect that you were a stockbroker and you led the Telstra IPO. Could you please elaborate a bit about this?
Sure. Yes, at JB Ware, the stockbroker, I led the research on the privatization of Telstra. This took about 2 years, and during that time, I went to essentially every financial city in the world, from Tokyo to Toronto.
Mm-hmm.
JB Ware is a leading firm in Melbourne, Australia, but nevertheless, it's a small partnership.
Mm-hmm.
This gave me a fantastic opportunity to learn everything there is about the equity markets, including some of the secret sauce. And I'd love to share a little element of that with you.
Please go ahead.
Great, thank you. Well, in the Telstra privatization, we had to create appetite.
Mm-hmm.
We did that with domestic investors, retail investors, and also foreign institutional investors. We also had control of the allocation, which meant we could choose how much stock was going to be put into Australia, Asia, Japan, Europe, and North America.
Mm-hmm.
As a result of this, we created enormous demand tension, which meant the IPO an absolutely huge success, oversubscribed.
Mm-hmm.
We managed to sell 1/3 of a company for 14 billion Australian dollars, which meant the whole company was worth over 50 billion Australian dollars. That was the biggest IPO in the world at that time.
Wow, that's super interesting. So let's continue with fundraising. You've been involved with fundraising across a range of companies, from startups to the listing of a company and their initial public offering, and then ongoing to head of investor relations. Is there a common winning approach to fundraising?
I think there is, and I call it the 3 C's:
Mm-hmm.
consistency, clarity, um, uh, and conciseness. Now, when you have these 3 C's, what it means is investor builds confidence and trust, and that will lead to that investor writing a check. And perhaps that's the most important 4th C.
The 4th C, the check. Yes, I think I can appreciate that. So it's all about building confidence, or I guess not losing confidence. And I can see that would be a very important step for a startup to show that level of confidence.
Yes.
Am I right?
That's right.
So, how does an entrepreneur build confidence and recover from a poor initial impression?
Well, if an entrepreneur has created a bad impression that first 30 seconds, it's very simple. They have to rebuild confidence and trust. That just means they have to stick to the facts that an investor needs to know.
Mm-hmm.
They want to know about the business model,
Mm-hmm.
the income model, what's different and unique about the company. And then a very important thing, the ask: how much money they're asking for and what that money is going to be used for. There's a last component too, which is an investor, their mindset is to buy low and sell high, which means they're looking also for an exit. And the entrepreneur should flag, are they intending to exit via a trade sale or perhaps an IPO in the distant future?
Interesting. So that means, for example, if you're part of the management team the management team and the business plan must stand up to scrutiny,
That's correct.
covering expected questions in a coherent and consistent manner. And once the investor is interested and hooked, only then will they devote time and effort and start the due diligence. Am I correct?
That's correct.
Okay, so thank you, Paul, for those valuable insights. How does that compare to investor relations in a large listed company?
Well, it's the same factors, confidence and trust.
Mm-hmm.
So in a listed company, there's quarterly reporting.
Mm-hmm.
So every quarter, the results have to be, again, in a concise, clear, and consistent manner, because the investment analysts there want to compare quarter on quarter, year on year,
Mm-hmm.
and then they want to see whether the results are above expectations, in line, or below. So a company at the beginning of each year often gives their guidance for the whole year ahead, sales and earnings.
Mm-hmm.
Also, you may have as many as 20 stockbroking analysts covering your stock, so you can get an average of what they think about the company. If those results are above the company guidance and above the consensus, good news. But once it falls below, then the analysts are likely to turn around and start changing the recommendation from a buy to a hold to even a sell. What that does then is, if the actual investor starts reading those research reports, they might lose confidence. If they lose confidence, then they have one action, and that is to sell the stock, and the price goes down.
And we don't want that.
Nobody wants that one.
So you mentioned earlier that the founder and the entrepreneur needs to sharpen their presentation skills.
Mm-hmm.
So is that also true of the CEO and CFO? Do they need to do the same?
That's correct. The language of the investment community is English, from Asia to North America, including Europe.
Mm-hmm.
So if anybody, a CEO, CFO, has got an accent,
Mm-hmm.
they need to take extra presentation skill and training to make sure that they communicate clearly and with confidence.
Mm-hmm.
Now, one aspect these days, though, is regulatory compliance. And so often listed companies prefer for the presentation and then the script to be fully scripted, so there's no ad-libbing.
Mm-hmm.
This ensures that what was meant to be said is said, and there's no mistakes made, which could lead to problems later. Then the presentation, the script, that's all uploaded to the corporate investor relations website for everybody to download and digest at their own time and leisure.
So that's not surprising at all,
Mm-hmm.
because everyone is more concerned about compliance and regulations these days. And so shifting on from this, I'd just like to ask about what are the most common mistakes a corporate company could make when engaging with institutional investors, and how can you avoid these pitfalls?
Right. Well, first of all, investment analysts are smart and very busy. They usually have an MBA or a CFA and years of industry experience.
Mm-hmm.
For a listed company, they cover your sector and your stock, and so they know all about the listed peers, and they can do benchmarking. For a private equity investor, it's much the same. That analyst covers sectors like medtech, fintech, software as a service. And they have seen many entrepreneurs pitch, and too many presentation packs that they care to mention. So again, they're experts in sectors.
Mm-hmm.
So the number one mistake that a CEO or CFO might make is being arrogant. That is thinking they know more about the sector than what the analysts do. Arrogance in itself is a poor leadership style and skill, and that can lead to people thinking that they're not going to listen to the rest of the management team, make mistakes, and nobody wants that to happen. So arrogance is a red flag to an investor.
Excellent insights. Thank you, Paul, for that. So what do you think, over the years you've been involved with investor relations, how has that role evolved over the past decade?
Okay. Well, first let me share a distinction on the IRO role.
Mm-hmm. Please go ahead. Yes.
Okay, great.
Yeah,
Thank you.
yeah.
3 types. First is administrative, then is financial and strategic.
Mm-hmm.
So the administrative role is the traditional one, which really is all about creating that glossy annual report, arranging meetings, coordinating interviews, the events management, physical events management.
Mm-hmm.
That's the traditional role. And then the financial role jumps up a level because here you're now dealing with the board of directors and the audit and risk committee, preparing that presentation pack, the script, and what's known as the management discussion and analysis of results.
Mm-hmm.
That's where all the financial and operational statistics come together. So they need to be able to interact with the board and the C-suite. In a good presentation pack, it's easy to highlight good news and persuade the analysts we're doing well. It's also then easy when there's bad news to say we acknowledge that, and this is what management is doing to mitigate that going forward. So it's easy to grab wins and to cover up on when things aren't going well. So an investor relations officer proactively engages with analysts to ensure they understand the strategy, the finance, and the operational statistics.
You mentioned a strategic IR role. That sounds like the greatest value add. However, at the same time, it also sounds like it's the most demanding type of role. So, what's the distinction? Can you please elaborate that for us?
Well, yes, the strategic role is probably the most challenging,
Mm-hmm.
but also probably the most rewarding.
Mm-hmm.
In dealing with the investment analysts, as I mentioned, they've got MBAs, they understand strategy, they eat it up. So the role of an investor relations officer is therefore to communicate the company's strategy, the finance, the operational statistics to those individuals. So you must be on par with them in your strategic thinking, finance, and planning. Another aspect to this is being a trusted advisor of board of directors. You can provide them feedback on decisions they need to make. Like, are they going to use cash for a dividend or a share buyback?
Mm-hmm.
Are they going to deal with an acquisition or a divestment? In these things, it's important for the strategic investor relations to understand the market, what they think, and how they might react.
Mm-hmm.
The reaction being, is this going to make the share price move up, firmer and fairer, or weaken it and move down? This is something that the board, the only way they can get that insight is from a strategic investor relations officer. Now, there's also one other thing here, and that is there's an administrative role of reporting on the 12-month investor relations plan. This is simply telling the board what you did over the last 3 months and what investors you met, who you plan to meet in the next 3 months, and what investment conferences you're going to set up for the CEO and CFO to present at somewhere in the world. We also can provide feedback. We can analyze month on month, quarter on quarter, the share registry. We can see who are the top 20
Mm-hmm.
investors, and we can see whether they're buying, holding, or selling.
Mm-hmm.
That gives us very good indication as whether those investors like and trust the company's strategy and management team.
Excellent points. That's really fascinating. So, for an investor relations professional, what is the common career path?
Okay, well,
I mean, sorry, go ahead.
Yes, the
Yes.
traditional administrative investor relations officer, they came from corporate comms,
Mm-hmm.
and junior role into investor relations, and then maybe aim for the director of corporate comms.
Mm-hmm.
Now, that's the historic role, but more and more over the last 10, 20 years, everything's online.
Mm-hmm.
The analysts now want a peer to discuss strategy and finance with, not a corporate comms glossy report. So nowadays, if possible, an investor relations officer would be recruited from a stockbroker, someone who covers maybe your own stock and the listed peers, because they know so much about what's happening in the market and what investors are thinking. Then the career path of that investor relations officer is to the top finance job, CFO, finance director.
So there's a big trajectory and a big learning curve here.
Mm-hmm.
Thank you very much for your insights on this. Let's move to sustainability and ESG.
Mm-hmm.
So I see that you have completed some very excellent executive management programs in ESG at the Cambridge Institute of Sustainable Leadership,
Mm-hmm.
and you also completed one at the Boston Consulting Group. So why are these programs of value, do you think?
Well, first of all, I firmly believe that any manager has to do lifelong learning.
Mm-hmm.
You've got to constantly stay ahead of the game.
Correct. Yeah.
Secondly, in the administrative investor relations role, it's shifted a bit because now ESG. So in the annual report, there is ESG statistics reported. So you've got to understand the terminology and the jargon and the way these are reported. Then more importantly, investors around the world care about sustainability and climate change. They want to know more about what the company is doing, what are the risks, what are the mitigation strategies. And so again, the investor relations office has got to communicate with those very smart investors. Also in that, again, reporting to the board. In talking with the investors, we can understand what the listed peers are doing and reporting in terms of their climate change strategy, risks, and then we can share that with the board of directors so they understand from a performance benchmarking point of view what's happening in the marketplace and in the industry.
Thank you very much. That's really, there's a lot of talk about ESG. So what are the critical components of effective ESG reporting that companies could focus on or should focus on?
Well, accounting standards have been evolved and approved and studied for many, many years.
Mm-hmm.
Yes, every now and again there's changes. However, in the case of ESG reporting, the standards are only now just getting approved and are stabilizing. So one of the aspects here is stock markets are now saying we want an integrated annual report. That means you've got the financial statistics, operational statistics, and now integrated the ESG statistics.
Mm-hmm.
Now, that annual report must be captured and reported in a consistent manner. So year on year, everybody can see the trend and what's happening. Now, that integrated annual report is signed off by the Auditing and Risk Committee, followed by the Board of Directors, and then is given to all the shareholders at the AGM. It's a very important process and document.
Excellent, Paul. Thanks for all the details. I've learned a lot today about ESG from you and about ESG reporting. So how do you think you balance transparency with competitive sensitivity when disclosing ESG and financial information to the market?
Right. Well, I think first let me explain where the conflict is. At the AGM, the chairman will talk about the strategy and give some broad ideas of where the business will be, the goals for the next 3 to 5 years.
Sure. Yeah.
However, the stock market and the board of directors tend to be very prudent. So they only share in detail a 1-year guidance. What are they going to do in the current financial year in terms of sales and profit? We jump across to climate change.
Mm-hmm.
This is about achieving net zero goals in anything from like 2035 to 2050. We're talking about 10 to 25 year forecasting and goals. That's a very big difference between giving and disclosing the 1-year annual guidance report. So fundamentally, there is a very big difference in that area of what you disclose. Secondly, board of directors are very conservative.
Mm-hmm.
They want to have absolute confidence that their 10 and 25 year plans and goals are solid. And so that also creates another conflict where they're worried about capability. Who's going to develop those plans and strategies and goals? Because that hasn't been done in the past.
So it's a learning game as we do more and more ESG reporting.
Absolutely.
So what trends do you see in sustainability reporting? And how should companies adapt their strategies to meet these investor expectations?
Well, we're very fortunate in that today we're at the starting point. I've dealt with a lot of the leading European investors who deal with sustainability issues and focus heavily on that. Having met and talked with them, it's simple. Start the journey. And they flag up, it's a long journey, just get started.
Right.
And so what they look for is the commitment by the board of directors and the C-suite. Do they have somebody who's responsible for sustainability? Is the board looking at sustainability? Are those risks being identified and put in the annual report? That's really stage one, the commitment. Then over time, they want to see, is there an action plan to mitigate those risks and to improve on decarbonisation strategy? So it's very simple. They just want you to get started on that long journey.
And I think in Singapore, people have started on this on a very robust manner. So just changing trajectory a little bit, could you give me an example of how this works in your sector of telecommunications?
Okay, straightforward. Focusing on environmental sustainability, a mobile operator has literally tens of thousands of mobile base stations. Each one of them uses kilowatts of power. That's an electric kettle on each one at least. Then they have data centers for customer records, billing, and network management. Those data centers are big and use a lot of electricity. So for a telecommunications company, the key thing is energy efficiency and effectiveness, and then renewable energy. And it even means that you might have to build your own solar farms to get access to renewable energy.
And can you give an example of a solar farm such as this?
Well, big global players like Vodafone from Europe, across Europe it's pretty straightforward. But in other countries they operate, like in Eastern Mediterranean and Africa, there's no renewable energy. In fact, there's not enough energy. So they are actively building their own solar farms.
Very interesting. That's a very interesting transition that a lot of telecommunications companies are doing currently. I'd like to change the topic a little bit to your experiences, your advisory and leadership experiences. You've transitioned from engineering to finance to management. So what leadership lessons have you learned in this transitioning over the past decades?
Yes, that question I've often been asked in my role as Executive Fellow at King's College Business School. And it goes back to my first degree, which was in quantum mechanics, which is a combination of just mathematics and physics. Now, physics is how the world works. Mathematics is modeling the physical world. And so I have applied that throughout my career. So in a thing called regulatory accounting, I have modeled telephone companies to work out how much it costs to terminate a telephone call on a mobile network. And that forms what's known as an interconnection price. Later on in stockbroking and investor relations, as we've discussed earlier, it's about doing business models, valuation. And I've valued and written research reports on telephone companies in Australia and across Southeast Asia. And then as an investor relations officer, I use those same skills talking with the analysts who also need to do the same things of how the business works and then build a mathematical model to explain that.
Excellent. You've explained that really thoroughly. What about the value of this investor relations role to bring value to the boardroom as an advisor? How do you go about doing that?
Well, again, the strategic role really with the board is just to provide strategic insights to inform their decision making. And the only strategic insights I can provide is what is the equity market thinking about the company and their strategy and their decisions.
Okay, thank you. Can you share an example where your strategic advice significantly changed the trajectory of, say, a project in a startup?
Sure. Well, first of all, entrepreneurs choose their own strategy.
Mm-hmm.
And so what happens there is my advice is centered around talking to investors and fundraising.
Mm-hmm. Mm-hmm.
So many entrepreneurs have that great business idea, raise the initial bit of funding, then they need more money.
Of course.
At that stage, they need to do absolutely solid strategic thinking with clarity, which converts into a robust business plan and a justifiable ask what money they want and to be used for what purpose. If they don't have clarity and robust plans, the investor is not going to give them money and they're going to therefore run out of money and go broke.
So that's in the startup scenario. What about the same question for a listed corporate? How would you advise a listed corporate to change the trajectory of their projects?
Sure. In a big company, a listed company, the board of directors decide the strategy. Management role is to create strategic options and all of those very comprehensive business plans, but it's the directors who actually choose the strategy.
Mm-hmm.
Now, I don't help them there, but again, just the same point, is in helping them choose strategies, I can give them strategic insights to what investors would value and what they don't value. And hence, if they make a good choice, this will increase the share value. Now, for instance, if you're a growth company, you need to deliver sales and earnings growth better than your listed peers.
Yes.
If you're a dividend growth company paying out cash in dividends, then you need to give a dividend which is better than the average of your listed peers. The only way they can get those insights is from a strategic investor relations officer who analyze all the listed peers in the country. And because investors have choice around the world, it's not just this country, telephone companies, every country has 2 or 3 telephone companies. So an investor will be looking at the whole universe of telephone companies. They want to know which ones are growing and which ones are just paying dividends, so that then we can help the board of directors choose the best strategies to work on.
Excellent. Thank you so much. Now I'd like to ask you about succession planning. I know that you have been in investor relations for many years. Do you foster succession planning and mentorship within finance and investor relations teams? For example, have you trained and mentored a team in the past, and how would you go about doing that?
Right. Well, many years ago, for a NASDAQ listed company, I created a process manual for IR. There's something like 18 processes. I've then subsequently used that as a training manual for coaching and mentoring and succession planning. Now, in a company, we have a large stakeholder group, board of directors, C-suite, company secretary, and direct reports of the CFO and business units. So all of these people need to know a little bit about investor relations and why we talk to investors and what we talk to them about. Now, deeper IR capability training is really for succession planning. And so across those groups, that's where some individuals who are on a fast-track leadership role would value having more detailed IR training and coaching.
And what have you done for that? Is there anything where a mentee can follow that? Or, for example, if a woman wants to be in management, how can women be mentored for such a senior IRO role?
Well, this is actually great news for women leaders, because although the IRO covers most of the functions, legal, accounting, finance, strategy, planning, women leaders tend to be very much in great positions in legal and accounting. So this lends itself to be an accelerated career path to the C-suite. So what the style of mentoring I do is on the job.
Mhm.
At the end of each quarterly results, I then would need to talk to the 20 odd analysts from stockbrokers and as many as the institutional investors I can, which may be another 10 to 20. Face-to-face telephone meetings. What I do in mentoring is I will do 3 or 4 of these, then I'll hand off to my mentoree for succession planning, and then that lady would then do the same meetings themselves, would lead those meetings. After we've done several of these, we'll then do a very thorough debrief, saying where I could improve, and then also giving feedback on where they can improve. So very much a two-way form of mentoring, which then becomes a trusted environment.
Absolutely correct. And would there be any other day-to-day mentoring where they could feel, sort of gain some feelings for the equity market?
Absolutely. I mentioned if you can, a company is likely to hire an ex-stockbroker for the investor relations role.
Okay.
Because they understand your company, listed peers, and the equity markets. If we're doing internal succession planning, the gap is understanding the equity markets. So I've developed a tool for this, which is every day at the end of the day, when the stock market closes, they've got to write a daily scorecard report.
Okay.
They look at our company, listed peers, the index, and write about how it's worked, how it's traveled that day, and also what has happened in your market and around the market and around the world, which could have driven that share price. By consistently doing this, 5 o'clock every day, they quickly, over a few months, pick up the pulse of how equity markets really think and feel. So this is one way I've developed to make sure that if you're not from a stockbroking background, you can then develop a stockbroking feel.
That's excellent. I mean, I'm sure your mentorees are excelling in their jobs currently. I'd like to also take a little bit of about your personal approach. I mean, it seems like you really drive in a passionate way, your team. You have led in a very sort of, you have the vision to bridge business, to bridge finance, and to bridge sustainability. So what drives you and what's your passion for driving all this?
Well, first is, as I mentioned, lifelong learning. But also in this, if we take sustainability as an example, sustainability is very interesting. But to make change, you've got to make a very solid investment justification. Otherwise, the company, the finance, the CEO won't adopt it. So that's one of the things which I think is really exciting, is creating change. And I have developed those skill sets over the years. Now, historically, sustainability was called triple bottom line: people, planet, profit. And the United Nations had principles of responsible investment, mainly for banks. And then the corporates follow with a corporate social responsibility scorecard. UN created further Millennium Development Goals. Now, all of this led to more and more focus on ESG. But right now, the reality is we've moved beyond statistical reporting. Investors want to know the risks, and they want to see management embracing those risks and doing change. This is so exciting to be able to create the justification for sustainability strategies and investment plans.
Excellent, Paul. So how do you see the future of sustainability strategy evolving over the next few decades?
Well, I think this is a big challenge because, as you mentioned, those sustainability plans could be 10 to 25 years out.
Yes.
Right now, most corporates do 3 or even 5-year planning. There's a big capability gap in terms of doing 10 to 25-year planning. So that's one aspect, is bridging that gap.
Okay, but for corporates, how would you go about bridging that gap?
Well, it comes down to training, getting advisors in who know how to do that.
To advise the team.
Yeah, and to build those teams, that style of long-term planning.
Excellent. So, what about small businesses? Do you think small businesses can also improve on sustainability?
Absolutely, yes. Environmental sustainability is about basically reducing your electricity, your fossil fuel, and reducing waste.
Mm-hmm.
So there's many things an individual, a home, and a small business can do
Mm-hmm.
in terms of reducing electricity. Turn the lights off. Turn that thermostat down on the hot water heater.
Mm-hmm.
Replace old and failing, inefficient aircon units with new ones. So it's actually very easy to focus on improving things. The last one is you can look in your rubbish bin. What waste is in the rubbish bin? And there was a process that created that waste. If you then do process analysis and re-engineering, get rid of the waste, and you save money.
Excellent. So by now, I know that you focus on how things work. Do you have a framework for sustainability that you've perhaps engineered in the past or used in the past?
Yes, I do. I call it Scribe.
Mm-hmm.
I'll start by describing the S, which is about suppliers. A business has contracts with the supplier. I'll give a supplier dollars, they'll give me a product or service back.
Mm-hmm.
It's measurable. Dollars, product, physicals. Scribe describes the 5 areas where there's contracts. Suppliers, customers, the regulator where you buy a license from, investors who give you money, but you've got to pay it back. B is for the business itself, and E for employees.
Mm-hmm.
So this is an absolutely comprehensive way of looking at all the contracts in the company. So as I said before, you look for waste. Look for waste in each of the letters. Scribe. Process re-engineer, cut out the waste. Now, the most elegant thing here is going back, there are contracts here, which means I can measure the dollars, the waste, analyze the savings. So it's very easy for the most kind of rigorous of CFOs to justify a sustainability strategy based on reducing waste.
Thank you, Paul, for sharing these wonderful, fascinating, and really valuable insights and your experience over the decades. I've learned a lot today from our conversation. So in summary, the key takeaways are successful fundraising is about building confidence through the 3 C's. So clarity, consistency, and conciseness.
Yes.
And to do the hard thinking work in formulating strategy and business planning, which is a must for any business. And in terms of sustainability, one should follow a consulting framework such as the Scribe. So you consider the suppliers, the customers, the regulators, the investors, the business itself, and your employees to form a whole holistic process.
Precisely.
So let's complete this conversation here. Thank you very much for your invaluable time today, Paul. And thank you for having this wonderful conversation with us.
Well, thank you for the opportunity of being here.
This is Dr. Nasha Haider from Innotech Consultants. I look forward to doing many more interviews with interesting entrepreneurs and professionals. Please do link in with me on LinkedIn. Thank you.